Are you confused between SIP and lump sum investing? Wondering which one is right for you? In this video, I will break down both in simple terms so you can invest smartly and grow your wealth. This is Saru from Saru's Wealth World, your partner in the financial wisdom. Let's get started. What is SIP? SIP stands for Systematic Investment Plan. It allows you to invest in the fixed amount regularly, like monthly, weekly, or even daily into mutual funds. It's like a planting a small seeds every month that grow over a time. Ideal for salaried individuals, helps in rupee cost averaging, builds a discipline in investing. For example, if you invest 5,000 every month for 5 years, even the market goes up and down. SIP helps the cost and the reduce risk. Imagine, Ravi is a salaried employee. He invests 5,000 every month in an equity mutual fund through SIP for 10 years. Over a time, he invests the total of 6 lakh rupees, that is 5,000 into 120 months. Because he invested regularly, sometimes he bought a units when the market was high, sometimes it was low. The balanced out his cost, that is rupee cost averaging. After 10 years, his investment grows around 10 to 11 lakh, assuming 12% average returns. SIP worked for Ravi because it matches his monthly income, reduce the risk and build a long-term wealth. Then what about lump sum? A lump sum investment is when you invest a large amount at once. Best for investor with a surplus cash, suitable in bullish and the rising market, helps in taking advantage of sudden opportunities. For example, if you receive a bonus and sell a property, you invested 2 lakh at once in a mutual fund, hoping it to grow it faster. Now let's look at Priya. She got a bonus of 5 lakh and decided to invest full amount in mutual fund at once. If the market grows steadily at 12% CAGR, her 5 lakh becomes about 15 to 16 lakh over 10 years. But if she had invested just before the market crash, imagine, her portfolio would have dropped sharply in the beginning and it would take a time to recover. Lump sum worked because Priya had extra money and patience to stay invested long term, but timing matters a lot. We'll compare both SIP and lump sum. In SIP, there is a regular investment and you can invest in a small amount also, but in lump sum, there is a one time and a large investment. SIP is ideal for salaried ones, as we already know, and the beginners. Investors, those who are new to stock market. Lump sum is with a large amount of funds and the level of risk is lower and averaging in SIP. And in lump sum, there is a higher risk and timing matters. Market timing is less important in SIP and the very important in lump sum. So, SIP reduces the risk and builds a habit. Lump sum may give you high returns but timed well and it is very riskier. So, which one should you choose? If you are new to investing and don't want time to give a market, go for SIP. If you have done your research and you have a larger amount to invest, consider a lump sum, especially in the rising market. And remember, you can also do mix of both. Smart investor uses both the strategies based on the market conditions and their financial goals. A smart investor like Arun, he uses both the methods. He runs a SIP of 10,000 every month. Whenever he gets a bonus and extra cash, he adds a lump sum of 1 or 2 lakh. Over 10 years, his SIP gives him a stable growth and his lump sum boosts wealth when the market performs well. Combination of both SIP and the lump sum gives you a balance, safety from SIP and higher returns, potential from lump sum. Still confused? Don't worry. Drop your questions in the comments. I will personally reply. And don't forget to like, share, and subscribe to Saru's Wealth World for more such financial insights. Invest wisely, grow steadily. See you in the next video.